Join us now, Ed Yardeni, Yardeni Research President. Ed, welcome. I actually was, I brought it up already. I was going to save it for you because I was thinking of you when I thought about it, and that is maybe it's better to be a technician. And just if you just look at internals and just ignore everything, if it works. And sometimes it works, sometimes it doesn't. But you've been whipsawed. You've been whipsawed all over the place by depending on what the tariff comments du jour are. Where are you now? I mean, you said 6,000. We're at basically 6,000. After this morning, we'll be at 5,900.
Actually, you're right, because you missed one of my whipsaws. I went back up to 6,500 a couple of weeks ago.
Yeah, when I might have seen that. It's hard to keep them all straight.
Joe, I've warned my accounts that I reserve the right to change my mind as often as the president does. But I haven't actually done that. I started out the year very optimistic at 7,000, dropped it to 6,000 and 6,400 in early March, then 6,000. And now I'm back up to 6,500. So, yeah, I really need to get a neck brace for the volatility that we're seeing coming out of Washington. But all in all, I've remained bullish. I think it's a bull market. I think we had a correction. I think we made a low on a correction low on April 8th. And I think we're heading higher over the rest of the decade. So my underlying bullishness remains intact.
Yep. I think you're like the popular kind of cars being sold now. You're a hybrid. Any I think, good market prognosticator uses both technicals and fundamentals. There's no other way, I don't think, to do it. You try to pick the best things that work for you.
I think the technical idea is okay for day traders, especially when you have this kind of volatility. Day traders love this kind of volatility, assuming they're on the right side of it.
You've been bullish, Ed, regardless of fundamentals, based on momentum, right? As far as I can tell, or based on thinking that we're in a bull market that is probably going to be resistant to a lot of things that, many times it is. Doesn't matter what the government or the president or anyone else is doing. Bull markets just happen.
Yeah, one of the things I've learned over the years is that it's incredible how well the economy does and how well the stock market does, despite Washington. I think you're right. In some ways, we've spent way too much time and attention on what happens in Washington, and we ignore the fact that the rest of us working stiffs do everything we possibly can to make things better for ourselves, our families, our communities, our businesses, and it's working. I think it's the resilience of the economy that's really coming through loud and clear here. I mean, if you're looking for some stability here, I think it's actually in the economic data. The weekly retail sales numbers look fine. The initial unemployment claims look fine. The capital spending outlook still looks pretty good. I mean, clearly there's uncertainty. On the other hand, the president is right to point out that a lot of money is being committed to onshoring in the United States. So stay with the fundamentals for the long haul, play with the technicals for the short-term trades.
Hey, Ed, explain the bond market. Yields are back down today. Part of that is because yields in Japan are down. Maybe the Japanese central bank is considering issuing fewer long bonds to pay for some of the money that they're going to be needing fiscally.
Right.
But these are pretty important. Every time the bond market reacts and yields jump, the stock market sells off.
Yeah, I think that's a very important relationship. We've sort of had the bond market and the stock market acting as vigilantes with regards to what is happening in Washington. And as we all know, the president pivoted from talking about reciprocal tariffs on April 2nd, Liberation Day, and then on April 9th, he reversed himself because on April 8th, we basically had the 10-year bond yield going from 4% to 4.5%. So that got his attention and made him realize that he does have to deal with another constituency that votes on a regular basis, and that's the bond market and the stock market. And the two have been working in tandem. The stock and bond vigilantes have reacted kind of coincidentally. Right now, they're calming down because they perceive that there is some light at the end of the tunnel on this trade war. And I think the stock market's looking past all this already into 2026, recognizing that this too shall pass. And times are good now, and they'll get only better.
Well, we were said on Friday, we went, okay, so you mentioned it. We went from escalation April 2nd, de-escalation April 9th,
Right.
back to some escalation on Friday, de-escalating. So I don't know which way. I don't know which we're in right now. But as far as the vigilantes, how do you look at this bill? And I don't know whether, a reconciliation bill really makes that much of a difference long term. But is it, you view it as 1.6 trillion in cuts that wouldn't have been there, or do you view it as another deficit-busting blowout bill? Which is it?
Well, I think from what I've seen, it looks as though it's going to add to deficits, not reduce deficits. I think the Congressional Budget Office, for what it's worth, is saying that, under current law, we're going to have another $20 trillion of government debt
The vigilantes are pretty wimpy. The bond vigilantes are pretty, they're like St. Augustine.
Really,
it's like, make me chase. They're still like, someday we need to deal with this, but not today.
Yeah, that's right. And, that's been my position is I'll worry about the deficit and the debt when the bond market worries about it. And every now and then the bond market seems to worry about it. It did that in 2023 when the bond yield went from 4 to 5% in a few months. We had that basis trade issue back on April 8th. And so that seemed to be a bond vigilante issue. But the bond vigilantes are not the only players in this game. The Treasury demonstrated on November 1st, 2023, that if the bond vigilantes don't like bonds and notes that the Treasury is issuing, the Treasury can simply issue more bills. And that's what brought bond yields down in 2023. And the bond market has a long memory and recognizes that they are playing against a very powerful player here, and that's the Treasury as well as the Fed.